Welcome to this lesson. In this lesson, what we will continue what we started last lesson, and we discuss more about the relation between the investment tools and give you the life cycle of the companies or the stock. So we'll start with the life cycle of the company and the stock also itself. So we talked about the growth and the maturity last time of the any company. So here is the main thing. This is what we're looking for because coming like an apple in the growth time. So it's coming the growth and portfolio. This both together give you an idea of how the company will do in the future. If you're comparing between two companies in communication or telecommunication, and technology, like Apple and BlackBerry, for example, you find the BlackBerry was the growth is higher than Apple one time, and then the maturity was also here. But it's take like half this one. Why Apple is continuing? This is what you need to know about any company. You need to invest why it's continuing in the maturity and why it's doing better. So you find the products, you find the stability in the company, future plans. It's the company, for example, in automobile industry, you find the cars like do hybrid cars, doing electric cars. So that's do you know that this company is doing for the future is very represent in the market. So if you're looking for Toyota, for example, the sales is 1.5. This is not the only indicator. So you need to know that if the car doing a green car or electric car for the future, that's mean that this period is increased. That's it worth it to be investment in because they have a plan in the future. So you invest in this company. That's mean the stock have a highest percentage to increase or be stable in the future, and you have your money. Also, the management. If we see what happened to Nissan and Renault when Carlos Ghosn left the company in that way, so you see the stock has been decreased. But how come? So some investors say, okay, these companies will not perform well as before, so they sell the stock. And some investors say, no, we have a belief in this company, in the French company or French management, Renault, or a Japanese management, Nissan. So we'll continue investment in this company. So who's right, who's wrong? This is the very personal decision based on experience and based on the base what we talked and what we will talk about the management. Then the end, it will be your decision because this is and also in the very beginning when we talk about the money management theory, also we add an emotional. If you are a very emotional guy or something in the stock market, no, you need to hold this. You need to think practical. You need to put an base and limit for your profit, limit for your loss, and also strategy for your portfolio. It's as we see, and we will discuss more strategies, so you know what strategy to put. It suits you, and it's not about emotion. See, this company is making better, so I buy more. Don't be like the Bitcoin investors or what happened in Bitcoin. There are no base to invest on or to think in the future. So what the company based on, why this Bitcoin is going up, going down, or only about bit. In the stock market, it's completely different. Here we have a base, we have a company, we have a decisions taken by the company and the future plan, financial ratios. We have many things to indicate you to buy or to sell or to hold this stock, and how long do you hold it and why you hold it this time. This all questions having a kind of answer if you need to answer them correctly and invest wisely. In this slide, as you see, we will mention the correlation between the stocks, the stock market in all, and some companies in the stock, comparing to the four main things. If we see, for example, the petrol or oil price has been increased, that's affect the stock also, but only in affecting the automobile stocks. Like for example, if the gas going up, so well affecting negatively the Toyota, Mercedes, or automobile industry only in the stock market, because people will not buy as before because the gas going up, or they looking for electric cars or this kind of stuff. So that's some in our industry here going down. In bonds, if the bonds interest rate increased, also it affecting the stock market here because of the risk, because investor is attracted to high return and low risk. So in bonds, if they increase the interest rate, so they attract more investors to buy in the bonds because it's lower risk and high return. That's why it's affecting and have a negative correlation with the stock. Inflation also one of the enemies of the stock market. The more inflation is going up, the stock market going down, because the prices has been increased, the power purchase also decreased, so they're affecting the stock market. Gold is the same, with the same concept of the risk, because here the return increased and the risk minimized, so people go to the gold as saving the value of the money and having a negative correlation with the stocks. The main question is why should investing in stocks in this situation? Because this is the sale. Like you go to any shop and you find 50%, 40% discount in the item, you know the value of it. So it's a very good chance to buy this item. Here it's the same. If you go to Apple and you find the stock is crashed like 20% or 10% or something like this, it's a very good opportunity to buy and buy more, because you know the company is reliable and the company is doing well and having a future plan and financially is stable. So you buy more because the future this will be increased. In American Airlines, for example, after the accident, you notice the company is doing well. They just bought a new plane and they expand in some countries. So you know this is only an accident and will be best, and the company will reform well in the near future. So you buy more. It's a discount. It's like a Black Friday, for example. So you go to the high with the lower price and the discount, and you buy more. So you sell in the future with high amount. Thank you, and see you in the coming lessons.